For more on what to expect from the Fed tomorrow, let's bring in Brian Smedley. He's chief economist and head of macroeconomic and investment research at Guggenheim Investments. He's a new face to CNBC, and he joins us from the very loud, very crowded Milken Institute Global Conference in Beverly Hills. Brian, it's great to see you. If I tell you I think they're going to break things if they hike rates tomorrow, do you disagree?
Thanks, Kelly. It's great to be with you. I disagree that tomorrow's decision is going to make or break the economy. Our sense is that the economy is already headed for a recession in the second half of this year, and that reflects the cumulative monetary policy tightening that's already occurred over the course of the last year. I think from here, what's important is the Fed's efforts to convince the broader public that it's committed to fighting inflation and doing what it takes to finish the job.
Brian, by the end of the year, will the Fed be loosening money or sort of paused?
Yeah, Tyler, I think if we look at the two major tools the Fed is using on interest rates, they're likely to hold rates steady in the second half of the year and potentially start easing in the first quarter of 2024. But that's only if the unemployment rate rises on the order of a percentage point, the way the Fed is projecting as of their March economic projections. And that's a pretty ugly scenario for the economy and for investors in our view. In terms of the balance sheet, the Fed is likely to keep shrinking its portfolio of securities, also known as quantitative tightening, and we think that'll continue also at least into the first part of 2024.
Brian, curious as someone who worked at the New York Fed, which is kind of the market's leadership position, we'll say, within the Fed. What do you think they think when they look at the board today and see the regional bank ETF down 7.5%? I mean, are they making calls to the FDIC? I don't know. Just take me inside this decision-making process 24 hours before their next rate hike decision.
Yeah, without a doubt, they're watching closely the price action across markets and particularly the stress in regional bank shares. I think what that demonstrates to me, the signal is that this policy of a significantly inverted yield curve is going to continue to put funding strain on regional banks, and quantitative tightening will continue to draw deposits out of the system. And so that's going to increase funding costs for banks in general, but particularly for the smaller and mid-sized banks, who also, it sounds like, are going to be facing additional regulatory pressure and a lot of supervisory scrutiny. And so the Fed is going to take that on board and consider the implications for the availability of credit and the cost of credit to the real economy. We heard Chair Powell talk about that at his press conference in mid-March, where he said that a tightening of bank credit conditions, which has been underway for more than a year, but will likely continue in the wake of these bank failures, that could very well take the place of alternatively rate hikes that the Fed might have needed to do in lieu of the stress in the banking sector.
Final question. You say a recession is your base case for the second half of the year. Is it going to be a little baby recession like Anna Delvey and your little baby feelings, or is it going to be something deeper and more prolonged?
Yeah, Tyler, I think the concern is that the Fed is committed to fighting inflation, and there are significant underlying inflation pressures to deal with. So the Fed is going to be intentionally late in addressing a slowdown in the economy and an increase in the unemployment rate. In the past, they've had the luxury of being proactive because inflation was well contained. This time, I think we face a situation where the Fed will, again, be very late in reacting. And at that point, investors will have to mark down expectations for earnings and probably PE ratios. So on the fiscal side, I think that's where it also gets interesting. We have a debt limit. We'll be watching closely to see if fiscal policy tightening comes out of that process. But the lack of fiscal and monetary policy support in this recession, as we expect, could prolong the process. Right. But I do want to emphasize that we see a lot of significant fundamental strengths on consumers and the business sector, which should help keep this a more mild recession on balance.
All right. Thank you, Brian Smedley, Guggenheim. Appreciate it, sir.